Traders are constantly searching for the exact top of a market before the crowd sees it. They hunt for leading indicators, looking for the signal that a massive, unstoppable trend is about to grind to a halt. This diagram illustrates what textbooks call regular bearish divergence. The top pane displays price action making a sequence of higher highs, while the bottom pane tracks a momentum oscillator forming a sequence of lower highs. To a retail trader, this visual contradiction is a glaring sell signal. The assumption is that the trend has exhausted itself, prompting aggressive short positions right at the peak. But within moments, the market ignores the drop in momentum. Price violently accelerates upward, breaking past previous resistance boundaries and liquidating those short positions. This scenario accounts for a massive percentage of capital loss among traders trying to be analytical. You follow the textbook pattern perfectly, only to watch the market punish the exact setup you were taught to trade. The mathematical indicator is not broken. The failure stems from an incorrect interpretation of what that indicator actually measures. This analytical error is the Instant Reversal Fallacy. Oscillators like the RSI or MACD do not measure absolute price direction. They calculate the velocity and acceleration of price changes over a defined rolling window. Velocity dictates speed, while heading dictates direction. Changing one does not automatically change the other. When a high-speed race car deploys a drag parachute, it experiences an extreme deceleration. The speed drops dramatically, yet the vehicle continues traveling forward in a straight line. Markets operate under the same physics. An exhausting upward trend will naturally generate weakening momentum readings, even as the final influx of buying pressure coasts the asset to new price highs. Treating a deceleration warning as a mandate to execute a U-turn means you are stepping directly in front of ongoing, massive inertia. Trend exhaustion is a state of vulnerability. A true reversal requires a structural breakdown of the price action itself. To use this data correctly, we have to redefine divergence as structural disagreement. The first-order state of a market is the price. It represents the invisible history of where transactions occurred, driven largely by inertia. The second-order state is the underlying order flow. This represents the actual consensus and participation rate of the buyers and sellers moving that price. This topographical model shows the exact moment of decoupling. As the surface price continues to peak upward, the structural columns supporting it from beneath, the order volume, are shrinking and becoming sparse. This friction is driven by behavioral mechanics. The tip of the peak is formed by uninformed noise traders frantically executing microtransactions, buying the breakout based entirely on emotion. Simultaneously, institutional capital, the smart money, is systematically scaling out of their positions. They use that final surge of retail liquidity to exit. Divergence is the visible mathematical friction between the uninformed herd entering and the informed institutions exiting. Understanding that friction requires pristine data. Executing trades on intrabar signals, meaning data from a time period that has not yet ended, is an operational trap. Technical indicators derive their final mathematical values exclusively from the closing price of a designated time period. This diagram shows a single active candlestick with a countdown timer. Because the time limit has not expired, the current price is fluid, causing the oscillator line beneath it to whip up and down in real time. With only 5 seconds left in the trading period, an aggressive downward angle forms on the oscillator, contradicting the price and displaying textbook divergence. But with 1 second remaining, a sudden price spike occurs. The math recalculates instantly. The oscillator snaps upward, erasing the signal from the chart permanently as the period closes. This is known as repainting. The empirical rule of technical analysis is absolute. A signal does not mathematically exist until the time period officially closes. Traders violate this rule because of a fear of missing out. The urge to secure a better entry price drives them to execute based on an illusion. Waiting for closed bar confirmation is not a passive trading style. It is an absolute mathematical requirement to protect capital from statistical noise. We also have to challenge the assumption that momentum mismatches are always a warning sign. The market often prints a pattern known as hidden divergence. This chart displays a structural uptrend experiencing a sharp pullback. Notice that the price bottoms out higher than its previous trough. However, the corresponding oscillator dips significantly lower than its previous reading. This represents a complete reset of momentum without breaking the core structure of the price trend. The oscillator hits the oversold boundary while the price line remains safely above critical support. This action proves that sellers exhausted all of their downward momentum, but still failed to push the price down to a new low. Where regular divergence highlights the exhaustion of the dominant trend, hidden divergence highlights the exhaustion of the counter trend. The exact same mathematical tool adapts to different market phases. Indicators are completely blind to market context. The trader is responsible for applying the correct interpretation based on the dominant trend regime. Divergence is a context-dependent diagnostic tool. It can confirm a trend's power exactly as effectively as it signals its decay. Navigating these different regimes shifts the challenge from market mechanics to psychological endurance. Traders frequently fall into the sunk cost fallacy. They hold deeply unprofitable positions simply because a divergent signal promised a reversal that never materialized. To survive, you must view divergence as an observation of changing conditions, not an execution command. The most effective framework for handling standard divergent signals is the yellow flag protocol. In motorsport, a yellow flag indicates a hazard on the track. It demands caution and strictly prohibits aggressive overtaking maneuvers. In the markets, divergence strictly prohibits aggressive counter-trend entries. When a divergence appears, you use it exclusively to tighten existing stop losses, scale out of partial positions, or halt new entries in the direction of the aging trend. To enter a new counter-trend position, you require an independent price action trigger, such as a broken trend line, to confirm the momentum data. Mastering technical divergence requires abandoning the amateur fantasy of predicting exact market tops. Instead, it serves as a sophisticated risk management diagnostic for evaluating structural market health.